I grew tired of listening to my heating unit, which operates using a heat pump, running constantly since I woke up this morning. So I turned it down 4 degrees and put on a sweater. I'm not going to look favorably on this month's electricity bill from the Nashville Electric Service, a municipally owned electric system. Tennessee is a public power state consisting of municipally owned or co-op distribution systems with the power purchased from TVA. The best way to describe this video is as a companion to my weekly blog post, which was published yesterday, January 22nd, 2025. The summaries that I provide for each purchase or sale discussed in my weekly blog captures a few thoughts. The mind is constantly racing from one thought to the next in a mostly silent and uncontrolled process. It does what it wants to do. It is impossible to capture more than a few of these thoughts in writing, at least in the time that I'm willing to spend writing them down. And a few more can be summarized and with placing some color over the written word when discussed in a video format, which I'm about to do. With a slight decline in Treasury note yields, and that is notes maturing from 2 years to 10 years, I have not bought any this last week in the secondary market and instead went back to buying 20,000 in the 3, 4, and 6 month Treasury bills with one 1 year Treasury bill purchased at the auctions that were held on Tuesday and Wednesday. The 3, 4, and 6 month Treasury bills have investment rates close to one another and near the midpoint of the current federal funds range of 4.25 to 4.5%. The signal sent by those yields is that the Fed will not cut the federal funds rate on or before the June meeting, which is inconsistent with the federal funds futures contracts that are used in the CME FedWatch tool, which still has a 25 basis point cut in the FF rate on or before that meeting is more probable than not. I see no reason for a rate cut given the current economic data, and a good reason to wait as inflation expectations have trended up since the Fed cut in last September. The 10-year tip break-even inflation rate was at 2.12% on September 17th, just prior to the 50 basis point cut in the FF rate, and closed yesterday, January 22nd, at 2.4%. The 10-year break-even inflation rate is viewed as the market's forecast for the average annual CPI over the next 10 years, which is required for the 10-year tip buyer, starting out with a much lower coupon, to break even with the buyer of the 10-year nominal treasury at the same time. I did not notice until this morning that Schwab had dropped its sweep account rate again to just 0.05%. I had a $6,000 Treasury bill mature in that account this morning. If I kept that amount in the sweep account for 1 year at the 0.05% rate, I would receive $3 in interest. So I have to do something. I decided to buy 5,000 in today's 2 month Treasury bill auction. In that account, I will be buying 10,000 at next Monday's 6 month Treasury bill auction to flush out the proceeds from another maturing T-bill in that account. In the blog post, I also discussed buying in principal amount 11,000 in investment grade corporate bonds. I'm about 2 weeks behind now in discussing corporate bond purchases. I am adding more that mature in 2026 and 2027 to capture slightly more yield. The yield curve does slope up from 2025. Tennessee does not have a state income tax, and I pick up more yield with these purchases than I would with treasuries maturing at the same time. I own over 300 different corporate bonds. The S&P 500 ETF has a symbol SPY, currently has a dividend yield of 1.16%. Maybe the Young Turks are not concerned about that negative real yield before taxes. Since I am focused on income generation, it does make a difference to me, and I would note that it is also near the all-time low for that index. The slightly lower S&P 500 dividend yield was hit at the height of the dot-com bubble in 2000, which was 1.11%. And this makes me uncomfortable and more than a little bit queasy with stocks given my capital preservation and income generation objectives. In my post, I have a link to a chart from the long-term trends website, and that all runs together, long-term trends, that has data on the S&P 500 dividend yield going back to the 1880s. My stock investment style box is value contrarian with a strong emphasis on dividend yields of more than 4% for new purchases. For assets held in my 4 brokerage accounts, the allocation of common stocks is close to 10% now. The size is still material to me at that level. It is common for me to be buying some stocks that are already in a bear market, having declined more than 20% from their 52-week highs, and that have dividend yields over 4% and PE ratios slightly less or more than 10 for non-pass-through entities. I've also been adding some to equity REITs that have responded negatively to an increase in intermediate term Treasury yields starting in mid-September. I also mentioned in the post selling 2 preferred stock funds. I eliminated the leveraged FPF symbol in one account, selling 83 shares for a profit of $235.99. I discussed that fund in a recent YouTube video titled, quote, Closed-End Preferred Stock Funds, which I will link in the More section below. In the post, I included a 5-year chart of FPF that highlights 2 potential problems with this CF, which are hypersensitivity to increased concerns about credit risk and interest rate risk. The chart starts out with a decline to around $10 per share during March of 2020. That was due to the credit risk concerns created and became intensified due to the pandemic. The next major decline started with the Fed abandoning ZIRP and QE in March of 2022 and the rise in intermediate term interest rates thereafter. It is the intermediate term interest rates that are the ones that I would compare to a preferred stock. The decline in FPF price was due to interest rate risk and that are inherent in bond-like securities that lack the protection of bonds. I will try to trade this CEF and view any realized profit in excess of the dividend yield as a victory. The 5-year annual average total return for PF, and that would be with dividends reinvested, was 2.51% through yesterday using the Morningstar data. In other words, a negative real return before taxes and inflation. My gut tells me that the chaos that is already underway and will likely be gathering steam in the weeks ahead and months ahead and over the next 4 years will not lead to the promised land for stock investors. CEOs may be giddy about Trump in their public pronouncements, as almost all are. But as Mark Colbert noted in an article published yesterday at MarketWatch, corporate insiders are, quote, more bearish than they have been in over a decade, end quote, now. There are easily identifiable risks to stocks and the economy that could result in a bear market defined as more than a 20% decline in the S&P 500 from the recent high or something much worse. The catalysts for the downturn may include one or more of the following: a rise in inflation and inflation expectations sufficient to cause the Fed to start a rate hiking cycle, or to do something worse, in my opinion, which is to cut interest rates in response. And I'm not, and they may do something foolish again on this score, as they did in 2021 by keeping ZIRP and QE when inflation was surging. Another catalyst, a possible catalyst, is a trade war started by Trump, forced deportation of undocumented immigrants who fill important jobs in the U.S. supply chain. And just to emphasize, I am not going to volunteer to fill a vacancy in a chicken slaughtering plant. Another catalyst would be a downturn in the economy resulting from massive cuts in federal spending and the other factors, including those mentioned above, and a continued rise in intermediate and longer term interest rates as the bond vigilantes respond to both fiscal and monetary policies. And lastly, and I could go on, a much needed valuation reset from abnormally high current levels. I do have the capital ready to invest more in stocks. I keep most of that in my Vanguard account and their high yielding money market fund that invests in U.S. Treasuries. So if I get a 30% decline, I will be moving more money into stocks.